All right, welcome to Burn Rate and Beyond. This is episode 4, I believe, the next installment of our CFO tip of the week. Today, we're here with Jeff Mazza, and as always, and we are talking about optimizing working capital management. So, Jeff, how you doing today?
Doing well, thank you. How about you?
Yeah, just hanging there. Feels like a Monday, but gonna do it. Um, Yeah. So, it's the end of April, so I also do taxes, and so I got through that April 15th deadline, feeling like 1,000 pounds have been lifted off my shoulders. So, it's got a little bit of a different energy here. So hopefully we can feel it.
Loved it.
Yeah, I guess let's dig in. I guess the first thing here is working capital. What is that? Is that different than cash? Like, it's fancy. It's one of the fancy accounting terms or finance terms. Yeah, what do you think about that?
Yeah, and I think that's a common kind of question, I think, to a lot of business owners where they might kind of think it's the same, but it is different. Cash is part of that, but if you really break it down and say, well, what is working capital? And by definition, it's the current assets minus current liabilities, right? So it's really a measure of short-term liquidity and some sort of operational efficiencies, really. But that's when it comes down to what it is. It's your current assets minus your current liabilities. So a positive number is positive working capital. A negative number is you got more liabilities than assets. So that's kind of what it is per se.
And I guess that makes me think also of the idea of managing a business out of a bank account is only part of the picture, right? There is also that, and depending on exactly the sector of the business and how complex things are, it could be a very small portion of the accounts payable, accounts receivable, and other things like inventory or prepaids that could significantly affect how things look in reality. So
Yeah.
good stuff. Yeah, I kind of forgotten about that definition. So the other part of the title here today is optimizing working capital management. So optimizing. What do you think about that one? Optimizing.
Yeah, this is, and it's, I think, a key component when it comes to working capital. And what I mean by that is, you have that definition, right? We have working capital, which is your current assets minus your current liabilities, but current assets and current liabilities each have certain components to it, right? So when you look at, say, current assets, you have cash as part of that, accounts receivable and inventory if that's part of your business, right? Prepaid expenses. And when it comes to liabilities, you have your accounts payable, right? The bills that you pay and any sort of expenses and short-term loans that are part of that. So when we say optimization, a lot of it comes down to, I would say, not managing, but knowing and understanding those drivers in each of those buckets. So, if there's a bunch of AI that's, coming into the business, like that's great. You make a lot of sales and there's money that's part of AI. And if it really kind of, outweighs your liabilities, like that's great. But optimization could really utilize each of those drivers, right? Maybe there's, trying to collect on, cash or from an AR perspective, to generate more cash, or maybe there's certain, payable terms with vendors, right? If you pay up front, maybe you get a little discount, right, to save a little money, which actually would improve working capital. So to me, the optimization really comes into understanding those drivers of each, assets and liabilities, but optimizing them, and almost in each of their buckets to make sure that you are establishing and creating really good, solid working capital.
That also can think of there's like a couple of ratios that are super important there that help understand that, which is like the quick ratio and the asset ratio, right? Which basically gives no matter how big the numbers are, the ratio is what's important. Like if you have, I think we usually work with a 2-to-1 or 3-to-1 ratio is where we kind of want to be for current assets over current liabilities. Gives you some wiggle room and is generally considered to be healthy. So that ratio works if you have $10 in the bank or $10 million in the bank. but I mean, we can circle back to that later. So that's also like, I guess that's a key financial metric that indicates the optimization, right? It's a measure of the optimization. So if it's below 1, then it's actually a negative situation, right? Okay.
And really quick, speaking on that, I mean, having those ratios, call them KPIs, having a pulse on that business, because it is. I mean, whether that's looked at weekly, monthly, quarterly, or yearly, or all of them, but it is nice to kind of have that visibility and a pulse on it, because you don't have to go into each one of those buckets of assets and liabilities. But if you had some of these liquidity ratios, that it might be a good pulse to see if there's any action items that need to take place, or things are running smooth, and kind of gives you that comfort.
So we've outlined a few different topics to kind of cruise through here that affect the working capital. So I guess let's just start with the first one that generates cash, which is accounts receivable. So one idea in managing accounts receivable is I guess the biggest risk with accounts receivable is that people don't pay you, right?
Mm-hmm.
Do the work or you provide the service, whatever it is, and they're really good, and then you wait and the money never comes. So what are some ways to mitigate that risk?
Yeah, I think even when it comes down to AR, there's I think a few different options really, and it comes down to knowing your customer, right? I mean, a new client comes on board, and you give terms to that client. Well, you're extending credit to them, right? But how well do you know them? So does that mean filling out credit apps and really understanding and knowing who this person is? And sometimes you might start off with 7-day terms, and let's establish credit to extend that to 14, 21 to 30 days maybe. Or maybe there's some sort of ways that you can actually get money up front from a prepaid, right? Collecting that cash, so you're minimizing the risk of writing any of that off as uncollectible. So some of those areas that you can kind of navigate from AR, but AR is very, very, I mean, it's important. It's supposed to be cash that's coming into that business, so you want to collect on 100% of that, knowing that there are risks out there that you might not. So those situations where you can try to mitigate that as much as you can, that risk is the better, because I mean things happen. So maybe one of the clients that owes you money, something might happen to them, and you might not be able to collect that. So trying to just mitigate that risk as possible.
Yeah, we were actually working with a client this week and helping them out catch up on their AR. And a client had gotten 2 months behind, and the sales manager was trying to starting to get really involved and pressuring them to talk and this and the other. And then out of the blue, they just sent an email and said, "Yep, we ceased business last week." So
Oh, whoa.
sorry. And that's the thing, right? Because like now there is no recourse, because the asset, the business or the business owner could have some assets if they were to file a claim, and in bankruptcy court there could be a payout, but really that's the only recourse now. So that's also the keep a pulse on customers, that to understand where they're at, how they're doing, understanding that. So but then the other thing that happens, one thing came up in one of our conversations, our concept of discussed, was doing a credit check. I think everyone's very familiar with credit, personal credit checks, but if someone didn't want to give their authorize a personal credit check, the business owner didn't want to do that, is there a way to do that with just a business, like at the corporate level?
Yeah, and there's a few ways, both I think from very, I don't say easy, but there's some other options. But I think at the very least is, new clients that come on board, is just give them a credit application to say, this is part of our process that if you were to join, could be a one pager, and it's really just looking for some sort of trade references, that having someone call and say, how are they paying? Like, do they pay their bills on time? Are there any issues, right? At least you're aware of any sort of instances that might occur, or, and granted that relies a lot on the owners giving you people that would say, good things, but it is you can uncover some things as well to make you aware. But there's business bureaus out there that you can, I think it's like Dun and Bradstreet. I mean, you can pay to have credit of companies kind of looked and researched to kind of give you some insights into who you're dealing with. More likely or not that they're going to pay, and they're going to pay on time, or there are some issues here that maybe you don't even take them on as a client, or maybe there's cash up front, due on receipt. There's certain things that you could do if things don't look as, makes you comfortable.
And I guess in some ways this is an interesting discussion in the software world, because nowadays most software is it's like a SaaS, software as a subscription, right?
Yeah.
And so it's paid by credit card, on like every month at the beginning of the month. But this is, I guess, a conversation around these more enterprise level clients where they refuse to put a credit card on file, and or institutions that like that don't really work that way. They need to have a traditional accounts payable process and need to have various authorizations and send out wires or ACHs or even paper checks. And I guess where was I going with this? I guess the nuance was that, like, when does it make sense to, I guess, I mean, sometimes the only way to get in the door is to offer credit, and
Yep.
oftentimes the bigger fish will just say, no, we pay 90 days. That's it. If you want to play, it's 90 days. But there's an option called an early payment discount, right? Like if you don't want to wait 90 days to get the cash, you can offer something like, it's called 210 net 30, which is like a 10% discount if you pay in 2 days versus paying the full price in 30 days.
Mm-hmm.
Is there like when does that make sense to try to offer that?
Well, that's not a bad tactic, right? I mean, ultimately, we're just trying to collect cash, right? Because cash is the driver of everything. But I think, I mean, a couple things that come to mind is, understanding what, the AR and the cycle is, if there are collections and taking place, or is there constant battle with clients paying, or in the case SaaS business, right? It could be offering an annual, subscription even at a discount to say we're collecting all that cash up front even. But to me, it's you can almost implement that right away so that you actually able to collect cash, because we're not talking about massive discounts, right? But at least there's incentive for people to pay sooner than later. Give them a little discount, but because the longer that they wait, the more likely that you might not collect that. So to me, is really kind of looking and understanding the clients there, looking at the AR, the aging, and just see if there's a battle, if there's a collection process in place. But there's no harm, in my opinion, to offer that even now, even good paying clients. I mean, you're ultimately trying to get cash up front.
Yeah. And have you seen situations where that's offered across the board to everybody, or only to specific clients with these sort of early payment discount?
I've seen, I guess, both, but even like on the bottom of like an invoice, it's almost like embedded in the accounting software that it goes out on every single invoice. Excuse me, where every bill that goes out, it's, hey, if you pay early, you get a little discount. And I've seen that both ways too.
Okay. Now, the other thing about the annual subscriptions is, I mean, obviously there's, like, let's say cash is king. So if you get the cash today, that's better than, waiting, to get it next month or the month after. So an annual subscription, you get, 12 months today in upfront. I guess the other, besides the cash, I've also heard that the less often customers pay, the slower the churn is. So it's also a way to slow down churn, right? So that's also like a battle that lots of subscription-based businesses fight is people coming and going, and for whatever reason. So the fewer opportunities that people have to opt out, the fewer that will opt out, and the longer it will take. So that's another advantage that's not just that isn't exactly capital management, but is part of maintaining a healthy business is
Yeah.
reducing churn. So annual prepayments are also healthy or good for that. Good stuff. I guess let's flip the coin and talk about so basically the idea with the accounts receivable is like we want to accelerate cash collection. Get the cash up front, sooner the better. The more upfront, the better, just because that provides stability for the business. So I suppose with accounts payable, it'd be the same, right?
Yeah, it's kind of that seesaw when you're looking at that formula, right? Your assets minus liabilities. So yeah, you want to have higher assets and lower liabilities from a liquidity so that you can be able to pay the short-term liabilities on the books. But a big part of the current liabilities are the accounts payables and all the bills that are coming out from that company. So that's the other side of it. Right? I want to increase the assets, but kind of lower the liabilities there too. So there's the similar, I guess, when it comes to AR, but these are, call it, vendors that you're paying. So maybe there are terms and or there might be some as you're monitoring working capital where it's could be seasonal or downtime. There's a lot of churn, and their working capital starts to turn the other way. But maybe there's some negotiations with vendors on their bills that maybe you could push it out certain like a month, or maybe there are discounts for them too. If we pay now, we can save a little cash too.
Yeah, I definitely remember on the CPA exam that they said do the math. The prepayment discount is incredible, an incredible discount. Always take it, and if it's offered to you, always take it because you can't get that rate at a bank.
Very true.
2% for 18 days annualized is an incredible interest rate. So that's one idea, right? To just kind of find ways to reduce the amount that you have to pay, push it out, which would give you more working capital in the moment. I've seen a couple of people try in order to get through a rough patch, negotiate like a one-time with all of their vendors, say, well, this month, give us 60 days. The next month, we'll go back to the normal 30-day process. And then that creates a gap that allows people to get through a rough patch. Because most vendors will be willing to work with you if you have a good history of paying and you have a good reason for explaining why you want to do it. Another concept is just pay less, right? Which comes into cost control. So any ideas about how to do that? Or
Yeah, I mean, I think there's a couple things, right? I mean, I think just on both sides, right? Both receivables and payables, but just having a good process and sticking to it. And what I mean by that is just your bills come in, it's processed. And whether you pay that weekly, twice a month, whatever it is, but just having a good process, understanding the payables is one. Two is to start looking at those payables, like what's involved with that. Is it looking at the costs that are associated with all those bills that are coming in, that maybe there's room to shave off that bone because might be some overspend, right? Maybe spends a little high, that we could can cut that back so that current liabilities start to decrease a little bit. But to me, it's all part of like the process as like business owners, is to really understand the business and what's going on in that business. But to me, it's kind of keeping an eye on that AP and the balances, and just to kind of see if there's any room that you can kind of shave off.
Yeah. I've also heard of this concept called a waste walk, where you kind of like walk through a process, or have different people walk through a process, and come together and say, okay, well, what can we do to remove maybe some excess spend. Typical ones are like ancillary software that some people are paying for that no one uses anymore. Contractors who are who are paid by the hour, who just inflating their hours, and if there's not a good checks and balances process, that one goes gets skipped or undetected lots and lots as well. So there's just ideas to like reduce costs to help manage the capital better.
And
I
even
guess.
just to chime in
Mhm.
real quick is that's such a good point, Chad, because there are exercises too very similar to that as, and even just going down, and it could be once a year, could be quarterly, could be twice a year, but just going through the expenses, literally line by line. Are these items that you actually need? These are ones that you want, or some things that you can actually reduce, or maybe negotiate, or some you can just eliminate, right? And just doing that exercise here and there, you start to uncover. And there are sheets out there, but you can start tracking and say, oh, by doing this exercise, we literally just saved like 20% on our expenses because we've realized there's a whole bunch of stuff here that we wanted, we don't need it, right? And
Right.
just doing that exercise is kind of eye-opening, but somewhat frequent, so you kind of keeping a pulse on it.
Yeah, and it's one of the things, like, there's always in any going concern, any business, there's always an inertia, right? So you say, oh, this is the way we've always done it. Okay, well, great, but is that always that's always the best way to continue doing it and going?
Yeah.
Because often what got you where you're at isn't what's going to get you to the next phase. Good stuff. What about compensation? Because, like, for most for most developers and people, is by far the biggest cost. What are the
Yeah.
ideas about how to reduce that or control it to help optimize, what we're calling this cash flow management optimization process?
Yeah, I mean, compensation is one of the largest, spend for any business. So it's always kind of looked under the scope, but there are certain ways that you can almost offer, pay people, good talented people to come in, but also keep them there too. And a couple things that come to mind are those RSUs, right, which is a restricted stock unit, and then some stock options, right, where it's not so much cash outflow immediately to keep that money in the bank, but it kind of rewards the staff, right? And you can have some sort of vesting periods where it doesn't start for another year, and then it starts to vest to kind of keep them in the company too, but it's not technically just cash leaving the bank, the business bank account. So there's other areas where you can actually, utilize similar things like that. And sometimes restricted stock units might be for a little large organizations, and stock options you might find in smaller companies, to kind of enhance to say, hey, you're in a growing company and you're going to be rewarded once we grow. So there's certain areas like that where you can kind of leverage some of those cool tools.
Excellent. That makes me think of that. I think there's a name for that, like the simple contract for. It's slipping my mind right now. It's called a safe agreement. Um,
Yeah, it's like the simple asset for future equity.
Yeah, exactly. That's one that's very common, and it's turned out. Well, I guess I've seen it used a couple of different ways. I've seen it used well for individuals who companies who are very cash strapped. It does create a little bit of a time bomb because it can peel back the equity portion for the founder, but it can be an effective way to manage the seesaw of, okay, how much capital we
Yeah,
have and how we use it. Good stuff.
but
I guess
those are good tools too for, like I was saying, like, because I think for any business, right, like you want to have, call it, the best people coming in, but then on the other hand, like you want to keep them there too. So it's like, how do we track people? How do we keep them here? And these are great, options to, especially for earlier, smaller companies where they're not just cash flush yet. But it's great. It's kind of like, you grow and we grow, and very, very
and
effective.
and speaking of cash flush, right? Like, is there a problem with having a bunch of cash? Like we were saying, like the 3-to-1, the 2-to-1, the 3-to-1 ratio is like a good, healthy, quick ratio, right? So that's like 2-to-1 would be $20 in the bank and 10,000 or $20 of current assets and $10 of current liabilities, or 200,000 to 100,000. It's like a 2-to-1 ratio. So is that, like, what if it was like $200,000 in cash and no liabilities? Would that be a bad thing? Like, would that be an inefficient way to run the business? Because then the current ratio is significantly higher?
Yeah, I think. I mean, to me is like I feel like every business needs some sort of debt, to grow and establish their own credit, really. But so debt is not that bad. I mean, debt's cheaper than equity, right? And when you're looking at maybe short-term or long-term debt, but it's to me, it's I mean, especially in a growth company, I mean, growth just sucks cash like a vacuum, right? So having cash, knowing the runway, at some point you're probably going to need more if you're growing, especially scaling that fast. But to say that you don't have any liabilities, is that necessarily a good thing? But it's not, I guess, bad, not having liabilities. But I personally just feel like you need to have some liabilities to really establish yourself as a business.
Excellent, excellent. Yeah, and then you also mentioned, that debt is cheaper than equity. There's also this concept of like getting equity investors to come in, and like there's timing around that. And do you have like a rule of thumb or some way to think about when it is a good time to go find investors or to different stages? Like what's your thoughts around that?
Yeah, I think just understanding kind of what is needed, I guess, for the business. Like, I mean, if you're saying, oh, I think we're going to need about $10 million right now to launch this, then, friends and family, little angel round, may get you started, but it may not be all of it, right? And maybe there's proof of concepts and milestones to say, well, if we raised 100,000, we can get some sort of proof of concept that you can go for, seed rounds, A rounds, all that stuff, where you're seeking a little bit larger investment, but you might be giving up a little bit more in the beginning. But so the debt versus equity is when you start looking at the structure there, because if you're looking for debt financing in your early stage, I mean, these are folks that are like, hey, we want our money back at an interest, but if this is such an early stage company, it's a little challenging because
Mm.
you might not know, like, is this even work? Do people want this? Like, is this something that can scale and grow? Um, but so as you start to get established, the debt financing starts to come in a little bit better and easier.
There's also options to convert one to the other as well, right?
Yes, I was gonna say there's convertible debt options where you can start off and then convert that into equity. Yeah.
Exactly. Well, good stuff. So basically, in summary, it seems like there's some known ratios about how to what were some sweet spots to give a healthy business can use as guidance to understand where they're at, and if they're going to be running into trouble or they're not going to be or they're going to be okay. And I guess just kind of I feel like the fundamental thing that comes back every single time we talk about this stuff is you mentioned just a minute ago, we need $10 million to get this thing off the ground. Okay, well that's a projection. That's a model based on the understanding of what is going to be needs to be done to get started and to keep going, and that's essentially the burn rate, right? Say, okay, well here we are. How do we go? How like what are we going to do? How much time do we need to make it happen? And how long do we have until we burn through it all? So the essentials of having a good projection and then tracking that on a regular basis is fundamental. So good stuff. Any closing thoughts?
Yeah, and just like kind of what you're saying, right? Even if you're not, right? I mean, in one of the episodes we talked about having a budget, and we were saying even just a bad budget is better than no budget, and this is even if you're just kind of running the business on the bank account, having insights into that working capital is I think also very critical too. Especially if you might have some seasonality in the business, but just keeping a pulse on it is, I think, number one.
Excellent, excellent. Well, good stuff, Jeff. As always, it's a pleasure chatting with you, and it's good and well, I always look forward to getting feedback from folks. So feel free to leave comments and reach out as you feel appropriate. Take care. Talk to you soon.
Thank you. Thanks, guys.